Okay, I already talked about the coupon. Register bond is not important. It's just a register your name or that kind of stuff, right? So we did a journal entry too, right? So let's do more examples here. Your textbook has this example, so maybe using this as another example and making journal entry right here. So everybody has this in the textbook, right? $100,000, that's the same as my example, 5 years, that's a 10% bond. Now my example was 12%. So periodic interest payment, It's
10,000.
10,000 per year, am I right? At 96, okay, that's another thing I want to teach you. Wall Street, including Wall Street Journal, when they reporting the closing price of bond, they using like that, 96. They never said. I don't know, that's a convention. Well, next time when you're looking at the newspaper, look at that. They love fraction. They never using decimal. That drives me nuts. I guess it doesn't make them look cool if they say decimal. They intentionally making it harder. And also they never using what? This. They just leave it at that. They just leave it at that. You're supposed to understand. That looks like a password or something, right? So 101, 1/4, what does it mean? Right?
25%.
So multiply by face, right? So bonds was $100,000 bonds. That means this bonds was issued at
100,000.
that was the issuance price, the selling price. So that means, can you translate that bonds were issued at premium? If bonds was issued at this, discount. You see, so that's another thing that you have to learn. So that's all they say on the newspaper at 96, and then you automatically thinking, oh, bonds were issued at sold at discount. All right, so sure enough, cash came in 96 only, and bonds payable. The discount. Remember, discount account is a debit side, and then when you amortize, you are doing credit, all the way to zero. So this number become 100,000. Okay. So again, I'm just doing your textbook. So your textbook also start with the easier method called straight line method. So it was a 10-year bond.
Mm-hmm.
Oh, 5-year bond. I'm sorry, 5-year bond. But it says semi-annually, so divided by 10. Oh, another thing that if it says a 10% bond, but semi-annually, can you translate that, the percentage? 5%, thank you.
5%
So
for 10 payments.
that's right. 5% 10 payment is same as 5 payment of 10. Okay? So I don't want to confusing you. So okay. So this is the journal entry. So what's in common in journal entry at a discount situation? What's in common? Amount is the same, by the way, for straight line method. Doesn't matter. What's in common? Did you notice that? If you didn't notice that, I'll make you notice. Interest expense recognized always higher than interest payment. That's important. That's the kind of punchline. For the discount situation, every discount situation, whether it's a straight line or effective interest method, always interest expense amount has to be higher than interest payment. Reason? Somebody complete my sentence. I've been saying that repeatedly. Reason?
Additional costs of borrowing.
Additional, thank you, extra cost of borrowing money. So guess, you already know, guess what I'm going to say later at premium situation. Exactly reverse. All right, so therefore, to minimize your pain of journal entry, I know Bonds is already complex enough. Now journal entry even more painful, right? Especially effective interest rate method. That's why all these authors very afraid to start with the effective interest rate method. Not the concept alone. Journal entry is very convoluted. So what did I say? This one, this number is the easy one, right? Go to easy one first. Journal entry. 5,000. How do you get 5,000? One more time. 100,000. 10% divided by 2 semi-annually, right? 5,000, 5,000, 5,000. How many times? 10 times. 5 years. Semi-annual. So you got that. And then you got the 400 earlier, amortization, right? 4,000 divided by 10. But that you have to know which side, debit side or credit side. That one you cannot be confused. Debit side or credit side. The 400 every 6 months. Joanne? Credit side because?
The discount is on the debit side.
Thank you. Because you establish discount at the debit side when you amortize. What amortization? You are eroding, right? How do you make the 4,000 smaller every 6 months? Only way you can make 4,000 smaller is to credit. That's how you're going to remember. I'm just teaching you this as least pain as possible, right? Okay. So 400 on credit side, right? You didn't do this yet. Pretend you didn't see this number. Are you with me? So you did it credit. Just add them up. 5,400. Just put that down. That's it. Done. That's discount, sir. So if I were you, I wouldn't start with the interest expense. I know a lot of students in the past, they start with debit interest expense. And guess what? One number. What happened at the time in the parade? Blackout. Total blackout. And frustration. Time. Oh, instructor said 10 minutes left to the final. Oh my goodness. Even worse. You cannot think clearly when you have under that. So don't start with the interest expense. Start with this and just plug the number. But how do you know that number is correct? Oh, interest expense is higher than interest payment. See? That's how you do it. You all right? Question? Okay. So here's the presentation. What's the relationship between these two? Which one is the wife? Bonds payable is the boss. Which one is the slave husband? Discount is slave husband always. They are the pair, companion. Rich or poor, rain or shine, they cannot divorce. They have to go to the end of the world. Now, I did show to that 5 years. This will become zero. This is going to be paid off. Debit, bonds payable, credit cash, 100,000. Right? All right. So premium situation. So now I can go a little bit faster, right? So 103. Okay. Premium is now established what side? Credit side. So you still have to amortize that. Amortize 10 times $300. So when you're amortizing it, do you credit or debit?
Debit.
You debit. You're going to remember that? You have to remember that much. All right, so here's amortization. Don't start with the interest expense, please. Just to do this first. Easiest one. Cash payment. Interest payment has to be done no matter what. And then you set debit side. So debit and credit right here. What's the plug? 4,700 only. That's the answer. And then please notice which one is bigger, interest expense or interest payment? Interest payment is bigger this time. That's exactly the opposite of discount. And then presentation of the financial statement, same thing. bonds payable, premium, they are inseparable. But in this case, they are both credit side. But this will getting trickle down, whittle down to zero, and this will be paid off at the end of 5 years. They both die at the same time. Question? Comment? Again, this is a repeat, just reinforcement, but logic this out. Don't memorize this. Some students actually memorize it when contract rate is higher, they actually memorize it. All right, so I guess you can do that, but you don't have to. Why you have to adding up your brain with the overload, right? You don't have to, because it's really making sense. When this is your promise, this is what market that you cannot control over the market. This is the invisible hands, supply and demand. When this is higher, then your bonds, not a good news. If this is lower than your bond, whether your bond is a superior, then you can issue at a premium. It's not that hard if you really logic it out. All right. So guess what now? Now interesting method, right? So numbers are a little bit more sophisticated, right? Okay, 8% present value. Okay, I don't have to go through this present value factors, how to find that, right? The table, column, row, N, I, that, right? So table has to be given. So don't worry, you don't have to start memorizing table for the final exam. Okay, I'll give you the table. Okay? Or calculate. Okay. Earlier our example was $96,000 when straight line, but now it's more sophisticated number because you are multiplying those factors. Okay, instead of looking at this is too busy. So just look at the table. Again, the table is the best. Your starting point, I don't know, you can see it in the back, 92,637. We just calculated that. So it's a starting point. Starting point. Always remember, multiply by market. Where's the market? Yeah, right here. Ignore the face rate, contract rate. That's the same. That's the payment every period. So when you are amortizing it with the effective rate, only thing you have to remember is a market. So carrying value, market. Amortize, update the number. Market, update the number. Market, update the number. Market, update the number. All the way to up to 100,000.